A capital market is a financial marketplace where long-term debt and equity-backed securities are bought and sold. It serves as a vital bridge between those who have excess funds, investors/savers, and those who need funds for productive purposes, businesses/governments. Unlike the money market, which deals with short-term funds, less than a year, the capital market focuses on long-term financing, usually more than a year. 1. The concept of capital market. The fundamental concept of a capital market is capital formation. It acts as a transmission belt that converts idle savings into active investments. Suppliers of capital, households, individuals, and institutional investors like pension funds or insurance companies who have surplus cash. Users of capital, corporations, entrepreneurs, and governments who need money to fund projects, expand operations, or build infrastructure. Mechanism. In exchange for their money, investors receive financial instruments like stocks or bonds that represent a claim on future profits or interest payments. 2. Structure of the capital market. The capital market is broadly divided into two main segments based on the nature of the securities being traded. A. Primary market, new issue market. This is where new securities are issued for the first time. The money flows directly from the investor to the issuing company. Purpose: to raise fresh capital for expansion or new projects. Key methods: IPO, initial public offering. A private company goes public by offering shares to the general population. Rights issue, offering existing shareholders the right to buy more shares at a discount. Private placement, selling securities to a small group of select investors rather than the public. B. Secondary market, stock market. Once a security is issued in the primary market, it is traded among investors in the secondary market. The original issuing company is not involved in these transactions. Purpose: to provide liquidity. It allows investors to sell their assets and convert them into cash whenever they want. Examples: the New York Stock Exchange, NYSE, NASDAQ, or the National Stock Exchange, NSE. 3. Key components and participants. To function effectively, the market relies on several moving parts. Component: description, instruments, shares, equity, bonds, debt, debentures, and government securities, GSECs. Intermediaries: stockbrokers, underwriters, investment banks, and mutual funds that facilitate trades. Regulators: government bodies that ensure fair play, e.g., SEC in the US, SEBI in India. Investors can be retail, individuals like you and me, or institutional, large banks and hedge funds. 4. Why it matters. Economic growth. It channels money into productive sectors, creating jobs and innovation. Wealth creation. It allows ordinary people to share in the growth of large corporations. Price discovery. It helps determine the fair value of a company based on supply and demand. Would you like me to